Okay. Hello, everybody. Welcome to Money Matters. I am your host, Hung Lu. I am with Cash Property Inc. And today we are going to be looking at a question that is going to lead to our thorough analysis from our friend Eddie. So thank you, Eddie, for sending this in, and I will attempt to answer that today. And the question was about how to calculate GPLP splits and what are some of the terms to look for. So I will answer that. So thank you, Eddie, for sending that in. So we are, let's see here, November the 4th on 2024. So as you can imagine, like we're almost at the end of the year. This is so crazy. So I do have a couple of shout outs. So let me get into this right now. So if you want to get a copy of the book, okay, and let me share this with you. Our book made it to #1 bestseller when we first launched this a couple of weeks ago. So I am offering this free. If you want to just type in below on the comments, type in book, and I will make sure that I send you the e-version copy of our book, Rising Above the Rest. Okay, it's a compilation with 12 other real estate investors about how we got through COVID and succeeded in real estate. Okay, so that is a #1 bestseller. So you're getting this #1 bestselling ebook for nothing. Okay, so the other thing is, so Eddie was one of the participants in the what do you call it? In the breakthrough analysis. And so you're going to see, get an idea of what we do in the breakthrough analysis. But if you want support on your analysis paralysis, this is a good way to do it. Okay, you join up with the group analysis, and we go through your deals, and we'll walk through every single step of your calculation. And this is done over 4 group sessions. Okay, so feel free to reach out to me. I don't have my contact QR code here today, but if you want to just DM me on Facebook or YouTube, you can do so, and then I will send you that information. So that is that. Oh, there is a first-time home buyers event happening this Thursday. If you want to attend that as my guest, please DM me and I will send you that information. Now, you have to be local. It's an event happening in Vancouver. And so if you're out of province, you're not going to be able to attend this. We are not doing it virtual. Okay, it is an in-person session, and you're going to come as my guest. So you'll meet me and the other speakers, and we will basically walk you through all of the changes that are happening. Yeah, there's a lot of changes happening in the last 6 months about buying, financing, and all that stuff. And so this 1-hour jam-packed session will basically walk you through how to do that. So let me see if I can find a quick image for you so that you could see it. Because I find that, being a visual person, like a visual learner, if you can see things, oh yeah, here it is. So I found something that will help us share that. So let me see here. So let me see, sharing. Okay. So let me share this screen. And if you are able to attend, this is the event that's happening this week. I know it says an hour and a half here. Give us that luxury of running a bit overtime, because you are going to learn so much in this session for buying your first place. Now, I know that it says here first-time home buyers or investors, and that's a really interesting point, because your first place could be an investment property, right? Like I house hacked on my first property. So I wasn't a first-time home buyer, but I was also an investor way back when. Okay, so if you are interested in attending this, let me know. I will get you a guest pass. All right, so what else? Oh, yes, I almost forgot this. And this was a super exciting thing for me to share with you guys. So I am also a part of Pineapple National. And if you don't know who they are, that is okay. Pineapple National is a mortgage company, a national all across Canada. Okay. And I am super happy to have joined them, because I finished their 1-week intensive training on being an agent, and it completely blew me out of the water. The level of support, the level of knowledge that they gave me in terms of working with clients, how to build out my business, was astronomical. Like I've been, doing real estate for 25 years, and I still learned something from that training last week. So a big shout out to my Pineapple family. I'm so happy to be on board. If you are looking for a mortgage, it doesn't matter where you are in Canada. Okay, you can work with any of our agents across Canada, including myself. So feel free to reach out to me if you need a mortgage. It doesn't matter if you're new to the industry or new to home buying, yeah, or if you're a seasoned investor. I work with seasoned investors who are looking for creative financing on getting their next investment or to finish the current investment that they're trying to get into. That's what I specialize in. Okay, so feel free to reach out to me. So, okay, so I did my 3 or 4 shout outs there. Okay, so let's get into Eddie's question. And, the reason why I do these sessions is really to help everybody get into real estate, especially real estate investors who want to make sound decisions about their next investment property. And so this question falls right into that alley about, okay, well, how do we calculate GP LP splits? Okay, so GP stands for general partners, which is an active partner, and an LP stands for limited partners. So if you want more information about those terms, I've got other videos on those. So, subscribe to my YouTube or watch some of my other videos or send me a note and saying, hey, Hung, I can't find your other information on the GP LP stuff. We will get that information to you. Okay, this information is out there to help you succeed. Okay, and yeah, that's my goal, is to help you succeed, give you the knowledge so that you can make good sound decisions. So let me share with you the Excel sheet. Let's jump right in there. Okay, so I'm going to share with you 2 ways to calculate. Okay, and hopefully you'll see this. Oh, okay, I've got 2 spreadsheets going. So let me see if I can just share documents here and we'll get, no, I can't do it that way. Okay, so I'm going to share with you the Excel sheet on calculating GP splits. So hopefully you guys see the right screen. Okay, it says my screen is paused. Okay, I'm just going to stop share altogether and then we will go into a brand new share. Okay, so here we go, GP splits. Okay, so you should see the Excel sheet going up, and I'm just going to walk you through 2 ways to calculate GP splits. And this is because of so many deals opportunities I'm looking at. I've got multiple deals depending on if it's like an 8-plex multifamily or if it's a hotel. But at the end of the day, that calculation is the same in terms of numbers. So this is for my 8-plex deal that I'm looking at bringing in one partner. And so this calculation is really, really easy because it's 50-50, right? Like I'm bringing one partner in, so it's one partner and me. So it's a 50-50 split. Okay, so this partner is going to get 50%. So I manually type that in, which is why there's a green cell around that number. So I'm just going to make this a little bit bigger here so you can see that. Okay, and then this second line here it's also 50% because it's 1 minus my 50%. If I was bringing in a partner, let's just say they're getting 25%, I would just go in there, type in 25, and it automatically calculates the other percentage point, which is the 75 for me. Okay, so I'm just going to go and update this so you can follow along here. Okay, so an LPGP. Okay, so from a GP side, from my side as the active partner, I want to know what my split is. But the thing to remember too is that if you're bringing in a partner, you want to know what their numbers are as well. Okay, because it's important to them. If you're bringing in a money partner, an investor, you want to know what their split is because you're going to have to present it from their point of view. What's the benefit to them? Okay, so in this point here, I put 25. So let's go back to 50-50. Okay, so in this case here, we're looking at a cash flow here of $200 per month. So the cash flow per year for that investor, okay, so this is already taking into account 50%. So it's going to calculate the $202 times 12 times 50%. Okay, so this investor is going to make $1,200. In the whole scheme of things, this isn't going to change anything. It's not a moving needle thing. Okay, so this automatically calculates the cash flow per year per that individual for 50%. The appreciation in this case, we're saying it's 2%. Okay, and the calculation there is based on my 50% times this B33 cell, which is $208,000. And what that is taking into consideration is my appreciation per year for 5 years. So we're running a 5-year projection. So every single year I'm saying, okay, the appreciation for the first year based on 2% is $40,000. In the second year, I'm getting an appreciation on 40,000 plus the original pricing or the original value. So the appreciation for that second year has gone up by 800 because it's the appreciation on the appreciation. Okay, so it's compounding appreciation, which is fantastic. So by the end of 5 years, there's going to be about $208,000, okay, in appreciation. So now that's why this number here is 104, because I'm taking 50%, which is the LP split, and I'm giving that to the partner coming in. So the mortgage pay down is a calculation based on this other tab, which basically says what's the mortgage pay down. And that is a calculation. Okay, so I'm not going to go into that part here because I just want to show you how the LPGP split number is. So this is an actual number based on 5 years. In the next 5 years, I'm going to have $75,000 in mortgage pay down. Mortgage pay down is one of the cash flows, one of the wins that a lot of people do not account for in their return on investment calculation, because it's one of those things that it's paid for by the tenant. But you do want to take that into consideration. It's a huge influx of cash that comes in when you go to refinance in 5 years. So it's a big number here. So the mortgage pay down at 50% is $38,000. Okay, so this investor, this LP is going to get about $38,000. So the ROI calculation is just basically the estimate payout per year, okay, divided by their B11, which is let me go back here. So B11 is how much money is left in the opportunity once we refinance from the construction. So now if so what this number represents is you're putting in 132,000 at the end of the 5 years, what's your return? And this return is per year. Okay, so that's really important to consider, because some ROIs that I see, they'll say it's 50% return, but that 50% return, it's based on a 5-year hold. So then you have to divide it by 5. Okay, so it's really, really important to know, are you talking about per year or talking about 2-year time frame or 3? And you need to just divide that by per year. So because we're using the estimate payout per year of 30,000, okay, then we're just dividing it by how much money we put in initially. So that's a 22.4% return. The other thing to keep in mind is that all of these numbers are estimated. You don't know for sure if it's going to happen for sure. Like there's no guarantees that you're going to get $200 in cash flow a month. You don't know for sure that it's going to be a 2% appreciation. Now I'm using a 2% number that's very conservative. Like it's super, super low. Like if you're in Toronto or Vancouver, you're way north of that, like, way north of 5%. If you're in the Calgary, Edmonton area, you may be, 3-4%. Okay. Some people are arguing, hey, Hong, you know what? We've seen 8% in the last 2 years. Okay. If you're in the Prairie province, well, okay, 2% then is generous. Okay. So this number is an estimated number. And so that's what you always want to be very careful about when you're running these numbers, is that it's a maybe number. Okay. We're anticipating this 30,000 return per year. So that gives us 22.4%. Now, this is an important number to keep in mind, because when you're looking at your opportunities, you want to know, like for me as a GP, as an active partner, I want to know what the LPs are going to be getting, because if they're getting 8% here, well, that might not be worth their time to come in at 8%. If your investment is showing 22, well, then yeah, maybe it is worth their time to come in and support this project. Okay, so that's why it's important to run it from the other person's point of view, because you want to know what you're presenting them as a return on their money. So in this case, a 22.4% is a very healthy return. Okay. And I always compare this again. So, okay, well, if I was to put this money, this 132,000 into a private lend, how does that compare? If I was in stocks, and some of my friends who are doing stocks, they are making 10%. Some of them are very aggressive and they make 15 to 20%. So how does this compare to their alternative options in terms of investing, right? Like what is their lost opportunity here? Okay. So that's one way to calculate the GPLP percentage. So Eddie, I hope that this answers your question. I'm going to show you another way to calculate it as well. If this doesn't answer your question, let me know, reach out to me. Like you've got my contact information, so feel free to do that. Okay. The other thing that you had asked me, well, what are the terms? Okay. So think of it from an LP side of view. What terms would you want to make it so that this was attractive for you? If this was a 22% return, okay, that's just one consideration. You might want to think about, well, how long do they need to be in here as a partner with you? After they stay in with you for a couple of years, are you refinancing and then kicking them out of the deal? Are you looking at selling the property and then there's no more infinite return at that point, right? At what point are you offering them a pref? Like, are you offering them a 10% preferred return year over year? Are you saying to them, hey, Mr. Investor, come in and I won't, as a GP, I won't see any money until you get all of your capital back, which is this 132. Okay. So you want to run through all of these scenarios from the viewpoint of the LP and saying, how can I reduce the risk? How can I mitigate the risk for them? Give them a healthy return, protect their capital, make it easy for them to work with me so that they want to do this opportunity with me. Okay. The other thing to look at this, the other way to look at this is you don't want this to be a one transaction opportunity with your money partner coming in. You want to make it so that they, enter this opportunity with you and then look at doing multiple opportunities with you. Okay. Because there's so many opportunities coming up. Okay. So let me now share another way to calculate this. So let me share another screen because I didn't carry that LPGP calculation through on that one as much. So I do have another opportunity where I can show this a little bit better here. So let me share another Excel sheet because I want you to see this from another point of view here. Okay, so here is the other spreadsheet. Okay, so, and it says it's paused. Okay, so let me unsure that. And let's see here. Okay, so here is the other spreadsheet. So you'll see up here where I've just colored it in. Okay, this is where the LP and GP split continues here. So in that previous example I shared with you, I was only looking for one partner. In this example that you're seeing here, there's four partners, okay? So there's an LP here and there's partner 1, 2, 3, and 4. Each person is going to come in with a different percentage of the LP split, okay? So here I've got 80%. So what I'm going to do is I'm just going to update this to say 50% to match the last example here. So each person's going to come in with 50%. Based on the amount of money we need to close on this opportunity. So in this case, it's $1 million. Okay, so that means each individual is going to come in with different amounts. Okay, me as the GP, I'm going to want to say, hey, you know what, Mr. Investor, I want everybody to come in with equal amounts. So let's say 250,000 is going to be roughly the amount that each person's going to come in at. Okay, so I'm just going to say this number divided by 4. So each person needs to come in with 153,000. Okay, so let's just say each person comes in with that number. So I'm just going to copy that down just for easy math. Okay, so you see right there, I've raised enough money. Okay, so I have a condition in my Excel sheet that says, okay, have I raised enough money? If I have, then it tells me I've raised enough. If I haven't raised enough, 2, 3. So let's just say one person comes in or all of them comes in with only 100,000. Well, then it tells me I need to raise another $600,000. Okay. So when each person comes in with 253,000 in this example, each LP is going to get 25%. So this is 25% of the 100 of the 50. Okay, so if you follow that through, so the LP is going to have 50%. These four individuals are going to have 100% of that 50%. Okay, the other 50 is for the GP. So you have to keep that in mind. So the great thing about this little table here is that now you're seeing it from their point of view. What is their return on this? Okay, so now this is a different example from the 8-plex calculation. This is for a campground that I was running. So in this 50%, if each person came in with 253,000, each of them would have 12.5% of the overall project. And this is how that 50% is done, because they have 50% of that 100% of the project. So each individual would have 12.5% of the whole project. Okay, so you can tell your GPs, hey, you would tell your LPs it's a 50-50 split. And if you were to put in 250,000 in this case, you would have 12.5% of the overall project. Okay, so that's the way you sort of want to word it. So based on this example, the cash flow per month is per year is about 1,000. There's a mortgage pay down of 3. We're anticipating a 5% appreciation. So their return would be 8% for like just over 8% based on them coming in at $253,000. Okay, so now this doesn't talk about return of capital or anything of this sort. This is just basically saying, hey, if you put in 253, you're looking at an 8.4% return on your capital. By running this scenario, you can say, hey, you know what? This 8% is not very attractive. Like if I had 253,000, would I put my money in and get 8%? Probably not, right? Because you could put your money into a GIC and potentially get 5 or 6%. I could put my money into a private lend and make 15%. So why would I put it in and get 8%? Nuh-uh. Okay, so you want to run that through the thought process. Now, yes, the mortgage pay down may be more, the appreciation may be more, the cash flow may be more. So this 8% could be higher. But based on this scenario, like you're already running it with your numbers, okay? So then this is where I would come in as a GP and say, okay, well, where do I need to put the percentage so that it's attractive for my money partners coming in? So it might be where I need to go up to 75. So if I come up to 75, okay, well, you can see the ROI didn't go up by very much, okay? So in this case, it may not make sense to do this opportunity. So then this is 80%. So now let's just say I went up to 80%. This doesn't seem like a great return, right? Because the cash flow is pretty low. The mortgage pay down is what it's going to be based on the calculation and the mortgage that we assume we're going to get and the appreciation. So now let's just say that the amount that we need to close is maybe 750,000. Okay. So not 75, I'm going to add another 0 here. And let's just say that the cash flow here is $10,000, $12,000 for the year. Okay, so then, okay, so now you can see that the ROI goes up to 14%. So you're going to want to run your numbers to find out, okay, well, what's the return to the investor? Okay, when do they get all their capital back? And how do we secure that, minimizing the risk for them? Okay, so those are the things that you want to run through and present it to the money partners. But you want to do that. You want to run through this analysis and make it attractive for them before you go to your money partners. You don't want to present this out. And it's like, if I go back here, if the return is only, go back a few steps here. If the return's only like south of 9%, you're not going to get many people coming in. It's a different type of investor coming in that is willing to take a 10% return on their money. Okay, so that is it. Okay, so if you need any additional support on this, please reach out to me. I am here constantly. We're also doing another round of the the group analysis, for the breakthrough analysis. And if you want to come in on that, let me know. Okay, we constantly have space for people to come in, share their opportunities, and we run through those opportunities together as a group. And I will walk you through those numbers, like pretty much what we do on these calls. Okay, that is it for today. Thank you very much, everybody, for tuning in. Have an awesome week.